Have you ever found yourself lost in the world of investing? I mean, with so many strategies and so much advice out there, it can feel like you're in a maze, right? But what if I told you that we've found a map? A map that distills the wisdom of 30 top investing books into 12 dominant money strategies. Welcome to our channel. Today, we're talking about 12 strategies that have stood the test of time. Strategies used by successful investors all over the world. Before we get started, if you're new here, make sure you subscribe and hit that bell icon so you don't miss out on our next videos. Starting off with diversification. It's a risk management strategy that mixes a wide variety of investments within a portfolio. You know, spreading your investments across various asset classes like stocks, bonds, commodities, and even real estate. Now, why would you want to do that? Well, each of these asset classes behaves differently over time. Some might go up while others go down. By spreading your investments, you're essentially ensuring that you're not putting all your eggs in one basket. This way, if one sector takes a hit, others might stay stable or even flourish, balancing out the losses. But keep in mind that diversification isn't just about investing in different asset classes. It's also about diversifying within those classes. So not just investing in stocks, but in stocks from different sectors, different countries, and of different sizes: large cap, mid cap, small cap. As Warren Buffett once said, diversification is protection against ignorance. It makes little sense if you know what you are doing. Moving on to the second strategy, value investing. It's about spotting stocks that are underpriced compared to their intrinsic value. These are often stocks from companies that might be going through a rough patch but have strong fundamentals. Value investors are like those savvy yard sale shoppers, spotting the hidden gems and waiting patiently for their value to be recognized. Now, how do you determine if a stock is undervalued? Well, value investors often look at ratios like the price-to-earnings ratio, price-to-book ratio, debt-to-equity ratio, and the dividend yield. These ratios can give you a sense of whether a stock is undervalued compared to its true worth. Keep in mind that the market might take time to recognize the stock's true value, and in the meantime, the price could go down before it goes up. It's not for the faint-hearted or for those looking for quick returns. Next up, growth investing. Its style of investment strategy focused on capital appreciation. Growth investors find the companies that have the potential for above-average growth, and these companies might be in a rapidly expanding industry, or they might have a unique product or service that's taking the market by storm. The key is, they're expected to grow at an above-average rate compared to other companies in the market. If you want to spot a growth company, you've to look at factors like earnings growth, revenue growth, and projected future growth. They're less concerned with the current price of the stock and more focused on its future potential. But yes, there is a risk factor, as these companies often reinvest all their profits back into the business to fuel their growth, which means they might not pay dividends. But if you pick the right company at the right time, the rewards can be substantial. Think about those who invested in companies like Amazon or Google in their early days. That's the power of growth investing. The fourth strategy is income investing. It focuses on securities that generate a regular income. This income can come in the form of dividends from stocks, interest from bonds, or rent from real estate. Now, these dividends or interest payments can provide a steady cash flow, which can be particularly appealing if you're looking for a regular income. Maybe you're retired, or maybe you just like the idea of your investments paying you regularly. But keep in mind that not all companies pay dividends. Like we said earlier, some prefer to reinvest all their profits back into the business for growth. So, income investors look for companies that have a history of paying regular dividends. Income investing can be a safer bet compared to other strategies, but it also has its risks. For instance, a company might decide to cut its dividend, or a bond issuer might default on its payments. Moving on, the fifth strategy is dollar cost averaging, DCA. In this one, you invest a fixed amount of money in a particular investment at regular intervals, regardless of the price. You could be investing $100 every month in a mutual fund, or buying $50 worth of a particular stock every week. Now, by investing a fixed amount regularly, you end up buying more shares when prices are low and fewer shares when prices are high. Over time, this can result in paying a lower average cost per share, hence the name dollar cost averaging. While DCA can help mitigate risks and take the emotion out of investing, it doesn't guarantee a profit or protect against loss in declining markets. And it involves a commitment to invest through all market scenarios. Next up, we have buy and hold. It's a passive investment strategy where you buy stocks, or any other asset, and hold them for a long period, regardless of fluctuations in the market. You're not trying to time the market or make a quick profit. Instead, you're betting on the long-term performance of the asset. Now, why would you want to do that? Well, history has shown that despite short-term ups and downs, markets tend to rise over the long term. So by holding onto an investment for a long period, you're likely to see a positive return. Buy and hold can be a less stressful strategy, since you're not constantly trying to time the market, but it requires patience and discipline. It can be tough to stick to your guns when the market is down and all the news seems to be bad. Moving on, the seventh strategy is market timing. In this one, you try to predict future market price movements and make buying or selling decisions based on those predictions. You're essentially trying to buy low and sell high. If you don't know how to predict market movements, some investors use technical analysis, studying statistical trends from historical trading activity, while others use economic data and news events. It's a bit like trying to read the ocean to catch that perfect wave. This strategy can be incredibly difficult. Even the most experienced investors find it challenging to predict market movements consistently and accurately. The eighth strategy is contrarian investing. It's an investment style in which investors purposefully go against prevailing market trends. They buy stocks when others are selling and sell stocks when others are buying. I know you might be thinking, why would you want to do that? Well, contrarian investors believe that the crowd can be swept up in emotional reactions, causing overreactions in the market. And this can lead to stocks being undervalued or overvalued. By going against the crowd, contrarian investors aim to take advantage of these overreactions. Remember, while this strategy can lead to high returns if the investor's analysis is correct, it can also be risky. It requires a deep understanding of the market and the courage to go against popular opinion. Next up, we have momentum investing. This strategy aims to capitalize on the continuance of existing trends in the market. The momentum investor believes that large increases in the price of a security will be followed by additional gains and vice versa for declining values. To spot such trends, momentum investors often use technical analysis to identify stocks with high momentum. They look at factors like trading volume, moving averages, and relative strength index. Momentum investing can also be risky. If the trend reverses, the investor could end up buying high and selling low, which nobody wants, right? Sir John Templeton once said, "The four most dangerous words in investing are, 'This time it's different.'" Moving on to the 10th strategy, quality investing. This one is based on a set of clearly defined fundamental criteria that seeks to identify companies with outstanding quality characteristics. These could be strong management, stable earnings, low debt, and a competitive advantage in the market. The biggest plus point of this strategy is quality companies are often more resilient during market downturns and have the potential to outperform over the long term. They're the classic pieces that stand the test of time. But to achieve this all, you need a deep understanding of company fundamentals and industry dynamics. And quality companies often come with a higher price tag. Next up, we have ethical investing. It refers to the practice of using one's ethical principles as the primary guide for the selection of investments in companies and funds. And ethical investors seek out companies that align with their values and avoid those that engage in practices they disagree with. Now, what kind of values are we talking about? Well, it could be anything from environmental responsibility to fair trade to diversity and inclusion. Some ethical investors simply avoid companies involved in controversial industries like tobacco, firearms, or fossil fuels. So this strategy can give you the satisfaction of aligning your investments with your values, but it can also be challenging. Not all companies are transparent about their practices, and what's considered ethical can vary from person to person. Moving on to the last strategy, index investing. This is a passive investment strategy that aims to replicate the performance of a specific market index. An index is a group of securities designed to represent a section of the stock market. For example, The S&P 500 is an index that represents the performance of 500 large companies listed on the U.S. Stock Exchange. By investing in an index fund, you're essentially betting on the overall market rather than individual companies. This can provide broad market exposure and keep costs low, as index funds are typically passively managed and have lower expense ratios than actively managed funds. As Warren Buffett puts it, by periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. Well, that's it for today. If you enjoyed the info in this video, we'd love to hear from you. Which of these strategies resonates with you the most? Are you a value investor at heart, or does the idea of ethical investing appeal to you? Maybe you're all about riding the trends with momentum investing, or perhaps the steady approach of buy and hold is more your style. Whatever it is, drop a comment below. And before you go, don't forget to check out our video on personal finance rules school never taught you. Make sure you hit that subscribe button and press the bell icon. Thanks for watching.